learning accounting in an hour and 15 minutes.
Sounds
Maybe
right.
even a little less. I have these handouts that I gave you. We're going to use that kind of as like our, I guess like our kind of way we're going to go through this, okay? Now, I always say, you know, why do they put accounting, you know, why would they put accounting on this ETS exam? Because believe it or not, even though you're not accounting majors, you're still going to have to deal with financial statements, no matter what aspect of the company you're involved in. So they want to make sure that you still have some kind of knowledge of the accounting you learned principles, which may have been a long time ago. And, you know, and you were like, oh, this was horrible. I want to forget this as soon as it's over. So now I'm going to awaken all those horrible thoughts that some of you might have had about accounting. So the first thing I handed out was a single sheet of paper, and I sort of call this the accounting vocabulary list. Remember in school you used to get a vocabulary list in grade school, and you were like, okay, take these words home, learn how to spell them and what they mean. Well, when I was teaching a lot of principal students, I came up with this because, you know, the first week or so it's like, man, how am I going to know all these account names? So this kind of goes through all the different accounts and what they would mean. So for instance, we start with the balance sheet, and also kind of tells you what the breakdown is. So we're going to have assets, and I also threw in they would increase with the debit and decrease with the credit. So, and if you had me for principals, you probably remember how I don't like the T account because I'm not a Tennessee fan, right? But we do have that T account. Okay, and remember there was debit here and credit here. Okay. So the accounts you would find in your assets are going to be like the resources of the company. So you're going to have cash, you're going to have petty cash, accounts receivable, interest receivable, rent receivable, supplies, inventory, investments. So those are resources. And those would be all, except for maybe the note receivable and investments, would be all current as long as they were going to either be used up or they weren't going to last longer than a year, like supplies and inventory. We wouldn't assume those assets would be with the company for more than a year, so they would be called current assets. Our fixed assets would be our land, equipment and machinery, office equipment, furniture, if there's vehicles, a building. Those would be your tangible fixed assets. All of those get depreciated, remember, except for land, because land has an infinite life. Thank goodness, right? Because we've done our job on it. And then what happens is the company will take depreciation on those assets because they're going to last over a number of years. So we call that accumulated depreciation. That's the account that keeps track of how much depreciation have we taken on that. Then you go into your things that are intangible. So they're the things you really can't touch. They're not like a building or equipment. Things like patents. If you're an inventor and you come up with some great concept, you'll go and you'll register a patent with the Patent Bureau in Washington, D.C., and that gives you the sole rights to that invention, okay? So that's an intangible asset. Those things we would amortize instead of depreciate. So if the patent is granted for 12 years or 14 years, I'm not really sure how long they are, you would amortize all the, if you had purchased that patent, how much you paid for it over the course of those years. Trademarks, and I put Nike swoosh, because what more could I say? You know that's the trademark for Nike. Always will be too, I'm sure. Copyrights have to do with rights to creative work. So musicians, when they write a song, they're going to copyright the lyrics. If somebody writes a reference book or a novel, they're going to copyright that. The textbooks are all copyrighted because then it means that someone can come in and use your creation, your creative creation, without paying you copyright fees. And finally, goodwill. And you might say, well, gee, you know, what's goodwill? You know, because when we think about goodwill, we think about goodwill is something that's nice, you know. But in accounting, result, when someone will pay more for a purchase, pay more for, say, a purchase of a company, then it's fair market value. And the reason why they're willing to do that is to pay more than what the sum of the assets of it are, is because there's some special feature, a soft asset that that company has, okay? So that would encourage them to want to pay. It may be just because the location of it is great, the reputation is great. So that's what we call goodwill. Okay, so those are typically your assets on the balance sheet, and then we move into liabilities. So if you remember, one of the first things you probably learned in principles of financial accounting was your accounting equation. Does anyone remember? Okay, I'll just do the work. Assets. You listen, that's your work. Assets equal liabilities plus equity. Okay, so that's our accounting equation. And that's what we're always working toward, to keep balance in accounting. This is also representative of our balance sheet, because on our balance sheet, we want our total assets to equal the sum of our total liabilities and equity, okay? So that's our accounting equation. So when we move on down to our liabilities are going to be opposite what our assets were. They're going to increase with the credit, and they're going to decrease with the debit. So they're going to behave opposite our assets because they're on the opposite side of that, equal sign. All right, so liabilities sounds like things we owe, right? The company owes these things. So accounts payable, which, as you know, is a company may purchase something and not pay the cash now. They may pay it later. So that would generate accounts payable. They may have other items, wages payable, interest payable, taxes payable. Now, if it's a larger amount of money that they want to borrow from a bank or any other lending institution, they may have a mortgage payable, they may have a note payable. Some of them could be short-term notes and some could be long. And remember, our break point on the categories is if it's over a year, it would be a long term, and if it's less than a year, it would be short term. Now, the account that everyone always used to love, because it's kind of a weird term, is unearned revenue. And believe it or not, it is a liability, because as the term says, it's unearned. We've not done anything, but we've gotten paid for it. That sounds like it's a pretty good deal, right? Get the cash and don't do anything. But it is going to be a liability until we do provide the services. Usually it's going to be tied in with services, or, as the best example, a magazine subscription. We have to pay for magazine subscriptions right up front. We pay for the year of magazines. Well, that company has that cash, and they have to record it in unearned revenue. Each month, when they send out an issue of the magazine, they're going to say, hey, we've earned now a month of the subscription revenue. And they'll be able to transfer that to revenue because they've earned it now, and they'll have less liability on the books, okay? But that's always been, I think, sort of a weird one to get down. Okay. If you flip over, the last section we have on our balance sheet is equity. So equity is on the same side as the liabilities. So we're going to increase with the credit. And this side is going to increase with the debit. Okay. And the things in equity are the things like the stock of the company. And remember, companies can have different classes of stock. So they could have preferred stock, they could have common stock, and they could also have treasury stock. If I'm talking too fast, okay? All right, so when we look at these different types of stock, common stock we're probably very familiar with, because I'm sure with your projects that you're doing in strategy, you're dealing with companies and they're all probably gonna have common stock, right? But preferred stock is just another class that's available for sale with a publicly traded company. Treasury stock, if you remember, is when the company decides they want to buy back some of their stock. And so they put it in the treasury stock, okay? And the reasons they might do that is because they may have stock compensation plans. They may give stock as part of their compensation, and maybe they want to build up their reserve of stock so that they can use it for compensation reasons. There's various reasons why they may want to buy back some stock. So those are your classes of stock. We're also going to have, remember, usually preferred and common stock, we're going to record what's in those accounts at par value. Okay? So and remember, the par values have absolutely no math foundation to the value of the stock. They're just an arbitrary amount that when they were getting together what they were going to do about issuing stock, they decided was a par value. So you could have a par value that was 0.01. Basically 1 cent a share could be your par value. But that's all that'll get recorded in those accounts. So naturally they would want to sell their stock for more than a penny. So where do they record the rest of it? They have to put it into an account called additional paid-in capital. Now, it also could be called a capital reserve, a capital surplus. There's a few different terms they'll use for it. The old-time way is additional paid capital. Okay, but I just recently saw one that said capital surplus. Okay, so that's where they're going to put whatever they sold the stock for above par is going to go into that account. And finally, we're going to have retained earnings. Now, retained earnings can be labeled. It can be labeled unappropriated or appropriated. So if it's unappropriated, they have no set purpose to having that retained earnings balance, other than perhaps they would pay dividends out of retained earnings. Because a lot of companies, have policies on issuing dividends. Some companies don't. Some companies don't issue dividends at all. It's totally up to the board of directors to vote whether they're going to issue a dividend or not. Sometimes they may say, okay, we want to set so much of our retained earnings aside because we want to plan this expansion, but we don't really want to get serious about it until we have so much in accumulated earnings. So they may set up appropriated retained earnings for that purpose, okay? So they split that money out. So that way when the board of directors looks to see how healthy is the company, how are they doing, should we issue a dividend, they know whether if they put aside the amount they want to put for the expansion, they have X number in unappropriated retained earnings. So sometimes they'll split that one up. Okay, any questions so far? All right, well, let's stay on financial accounting. So, not the first page, because that's managerial, but the second one is financial accounting. And basically what I've done is go through and I sort of went through the principles book and I took terms that I thought might come up, and basically that's, how I put together the guide. Okay, so if you remember, we have financial accounting. We can kind of put these two together. And then you took that as principles 1, and then you had managerial accounting. And they have some very distinct differences. Okay, so first off, let's talk about who are the users of the information that these types of accounting provide. All right, so in financial accounting, we're mostly putting together our financial statements. That's probably like the acme of the process, you know, is to put together those financial statements. Okay, and the reason why is we want to be able to show prospective investors how well we're doing, hopefully how well we're doing, and we also want to be able to have access to more capital to expand our company. So we want to have a good set of financial statements to show creditors. So the primary users will be creditors and investors. Now, when we talk about managerial accounting, you remember that's kind of how we lay out what's going on inside the company. We're going to only have managerial accounting information. It's going to be used by the insiders of the company. It's going to be internal use. Bless you. Okay, so those are our users. So two very distinct groups, right? Okay, the next thing is, let's talk about the regulations. So, you know, accounting is all about rules, right? Pretty much. Okay, financial accounting, tons of rules, okay? All right, so does anyone remember, what's the set of accounting standards called? Starts with a G.
GAAP.
GAAP, right. And it's GAAP, not like Gap, the store. Okay, so that's the generally accepted accounting principles. Oops, this pen is dead. Okay, so that's the generally accepted accounting principles. That's the gold star of accounting rules. Okay, managerial accounting, you gotta love this. No rules, okay? But they follow a value-added orientation, meaning as long as they get more value out of a report than the cost and effort and time that's spent doing it, then it's a good thing, okay? So if there's a production report that they can do that's going to give information to all the different departments that are working together, and it's not very cost expensive wise, they're going to do that report, okay? So it's really just based on, if it's something that adds value to the company, it's fine, go ahead and do it, okay? So managerial accounting is probably a lot less like rigid, you know, whereas financial accounting, you got to do it this way. All right, so let's see, users and regs. All right, so let's talk a little more about this regulations. Okay, so the next question we would probably ask is, who is the group that puts these GAAP rules together for us? And if you remember, well, they are called the Financial Accounting Standards Board. And you know, they always have these acronyms. It's FASB, F-A-S-B. That puts together all those GAAP regulations. Now they do take a lot of input from industry leaders and all, because sometimes they don't realize what the implications will be with certain rules and regulations. That's why sometimes they're proposed and they put them out there and see how it goes. And you know, they can always raise issues with them, and they may, you know, amend them, because obviously we can't know everything about all industries and companies. So there could be some, you know, thing that would not be fair to each type of industry. Okay. The other thing that we're facing in the United States right now, as well as a lot of other countries, is that there's a real push. And I know through other classes you'll hear, you know, we're operating in such a global economy now. It's a worldwide economy. So if you think about all the countries in the world, and you think about how many countries have their own sets of standards for accounting, and one company that's based in the US may have 50 other subsidiaries located in 40 other countries or whatever that all have their own sets of standards, there's been a real push, probably at least for 10 years now, toward an international set of standards. And they're called the International Financial Reporting Standards. And the acronym is IFRS, I-F-R-S. Okay, and the group that puts them together is the International Accounting Standards Board. IASB. Okay, so over time, the United States has really worked hard on the GAAP to make sure that they were good regulations. They offered a lot of transparency in terms of the financial reporting and all. So when you have good regulations, it's hard to say, okay, we're going to go with this other set of regulations when we already have a great set of regs in place, right? That would be a hard thing to do, because just think of how much money and time and expertise would be involved learning a new set of standards, converting what we have over to that. So there's been some resistance, and it's mostly been from not just us, but other countries that have good standards in place already. So what the US has decided is, rather than just go out and just adopt each of those standards, they're going to converge. So I don't know if that's going to be a buzzword or not on the test, but I thought it could be. So they're going to converge, because what they're going to do is, where they're very close to what IFRS says, they're going to sort of maybe change a little so that they can be on the same standard completely. And IFRS is going to bend a little too. So they're going to try to compromise on regulations. Well, naturally, guess how long it's taking? It was supposed to be done 7 years ago. We're not done. I think, maybe they have like 30 regs that are converged. And there's a ton more than 30. So anyway, so this is what we're in the process of doing, and probably will for a long time in the future. So that's the word. And we're not the only ones that are converging. There's other countries as well. Because think about it, the other thing is rule setting that are going to affect the entire world. Countries become very territorial in terms of their power, and nobody wants to give up power, so that's another issue at stake here. Okay, all right, so along with the regulations put out by GAAP, if you are a company that issues stock that's traded in one of the stock exchanges, like New York Stock Exchange or the Amex, you're going to also have to comply with the Securities and Exchange Commission. Okay, so, and we know what this one is, right? SEC. Okay, so you're going to also have to follow the SEC regs if you're a publicly traded company, because we have really messed things up over the years, right? Enron, WorldCom. So they are the oversight. I mean, I'm sure this stuff's still squeaking through, but they've tightened it up. They passed Sarbanes-Oxley after we had the big collapses, to try to make sure that things are more appropriate. Okay. Any questions? All right. Okay, we talked about our accounting equation. Let's just go over what are the steps in the accounting cycle. How do we get to the almighty financial statements? you're working in accounting in a company, and some of you were saying, never in a billion years, and some of you were saying, I can't wait. Well, anyway, you come in the morning and your desk has a bunch of papers, and you check your email, and there's a bunch of things in your email. So you have to record. You have to start taking what's going on in the company and translating it into the language of business, which is accounting. Okay, so the first thing you're going to do is you're going to record the transactions. So you catch everything up, and during the day there's more stuff that comes your way. You'll have sales, you'll probably have purchases if you're a merchandiser or a production company. So you're going to record all those transactions, and that's going to kind of like set up the history of the company that day, what's going on. Okay, so once you get all those transactions, and of course you're using accounting software, because I don't think there's anybody left that's still doing it by hand. Well, I'm sure there's a little business somewhere, but mostly they're using software programs, which are great, okay? Except the only thing is you're still gonna have to know how to do those journal entries, right? The debits and the credits and all that other good stuff. So once these transactions get recorded, and meaning transactions, you do the journal entries. The next thing is that they're going to post to the ledger. Now, in the old days, when I first started working in public accounting, we did have companies that were still doing it on big ledger books and pencil and paper and adding by hand. So we really did have a ledger book. It was about this long, and each page was a different account in the company, okay? And you would have to do your journal entries and take them, and you post each journal entry to this ledger book, okay? Now, you kind of click a button in the computer, and it, boom, it's there, you know? Okay, so that's what it means. It means just take those journal entries and put them to each separate account, okay? Now remember, each company is going to have a lot of accounts. So if we think about what the name is for all the accounts of a company, it's the chart of accounts, okay? It's numbered, which should help it make it be easier. Something wrong?
I kicked the camera, but
Oh.
I fixed it. It's all good.
But it didn't fall. So
No,
you're
I
good.
know that was my goal.
Okay, so chart of accounts is going to be numbered accounts for every account in the company. And luckily, most of the software packages will have sets already sort of set up for you, and you just pick and choose the ones you need to use. Okay, so when you're posting to the ledger, you're going to be posting to one of the accounts they have. Okay, so once you get everything in there, and especially when it was still by hand, usually at the point of toward month-end close, because usually they like to come up with some statements every month, especially in a big company. Once they get it all posted to the ledger or the T accounts, then the next thing they're going to want to do is they're going to want to prepare an unadjusted trial balance. And I'm going to abbreviate trial balance as TD. Okay? So the only thing this is going to tell them is that they didn't mess up their debits and their credits. Because if they did everything correctly so far, debits will equal credits. They may have posted them to the wrong accounts, or they may have written the journal entry incorrectly, but it's just telling you that they have the same amount in their debit column as their credit column. Once they do this, then they have to see what accounts do we have that we might have to adjust at the end of the month. Because remember, this was probably one of your nightmare chapters. They're going to have to do their adjusting entries, right? So they'll prepare adjusting entries. So some examples of preparing adjusting entries is maybe they paid their rent 6 months in advance, okay? So when they pay the rent initially, it's an asset. It's a prepaid asset, prepaid rent, and they paid their cash for it. So every month that goes by that they use the space that they're at, they've actually incurred rent expense. So at that point, they have to take a month of that rent and record it to expense. So one example would be to debit rent expense and credit their prepaid rent. And there'll be other items similar to that where they may have to make adjustments. There could be recording depreciation on their assets each month. Because usually that's what companies do, because when you've got a bigger company, a month can make a huge difference in a company, so they want financial statements each month. Okay, so your adjusting entries are always going to involve a balance sheet account and an income statement account. But never cash. Okay, so you're always going to have a balance sheet account and an income statement account when you do an adjustment, never cash, okay? So once you've got that done, and usually every month your adjusting entries are going to be very similar because they're going to be things you'll do. And actually in the software it's great, you can set it up and you just say, okay, you know, remember my adjusting entries, and they'll pop up for you. Okay, so once we get there, because accountants are kind of anal, we have to do another trial balance. So we'll prepare an adjusted trial balance, just to make sure we still have debits equal credits. All right, so now we're ready for the big moment. Now we can prepare our financial statements. Okay. So there's a certain order we have to follow because certain ones of the financial statement provide us with an account balance that we need for the next one. So what we usually do is we start with our income statement. Does anyone remember what the income statement is going to tell us? What do we find on it? What type of an account? Does anyone remember?
I know there's like sales on there.
What's that?
Sales is on there. I know
Right,
that,
right.
but
We're going to have revenue type stuff, right?
Net profit?
Yeah.
Right, and at the end of the road, hopefully we're going to have net income. What do we have to subtract from the revenue to get to net income now?
Expenses.
Expenses.
There it is.
And unfortunately, we not only could maybe get net income, we could get net loss. Okay, so we kind of need that number first before we do the rest of it. So the next one after this number, the net income or net loss, is going to go into our statement of retained earnings. And basically what that's going to do in that statement is we're going to run through what's gone on with retained earnings. So we're going to start with our beginning retained earnings, either the beginning of the month, beginning of the year, depending on what period of time we're doing. And we're going to add net income or subtract net loss. What else goes out of retained earnings? If you're a stockholder, what makes you happy?
Dividend.
Dividends. We have to subtract our dividends if there were any dividends paid. And that will give us our ending retained earnings. Which is the next magic number we need. Okay. All right, so then we take our ending retained earnings and we're going to do our balance sheet. Okay, and balance sheet, just like the accounting equation, assets equal liabilities plus equity. Okay, and we actually do have 4 financial statements. The next one is a statement of cash flows. Basically, the statement of cash flows looks at, what do you think it looks at? Cash. So we'd start with beginning cash, and they have it broken up into activity areas. We'd have an operating activity, investing, and financing. And finally, what we get from that is, where's our cash at the end of the year or the end of the month? Now, here's the trick. When you get the ending cash on that, it has to equal the cash that you showed on your balance sheet. So that's how you know if you've done it right and closed the loop in those financial statements, because that ending cash should equal the cash you show on your balance sheet. Okay, now these statements cover different periods of time. The income statement, the statement of retained earnings, and the statement of cash flows, they're going to cover a period of time. So they're going to do an analysis of a month, a quarter, a year. But the only one that's different is the balance sheet. The balance sheet is as of one day in time. So your balance sheet is always going to be dated one date. It'll be the end of the quarter, the end of the month, the end of the year. So the balance sheet is the only one, because how could we do those over a month? It wouldn't make sense. So balance sheet is one day in time. Okay, so once you get all the financial statements done, now if you're a publicly traded company, you get your financials done, and then what happens is you have to have those audited, because you're going to be preparing an annual report. You'll also be doing a 10K for the SEC. So you'll have one of the public accounting firms, a group of CPAs will come in, and they'll audit your financial statements and any other information. Internal controls, now they've added that to their requirements as well. And they'll make sure that everything is as it should be, and then they'll sign off on it. Okay, so that'd be the last step. Now, while you're doing all this, putting the financial statements together at year end, the auditors are already been doing their planning. If you have inventory, they've done their count the day you're, last day of your year. So they've been already working with your records before they actually start looking at the actual financial statements. All right, but for you, the next step in our process here is to do the closing entries. Because even though you've gotten those financial statements completed, that was just for a certain period. You've got to go on and get ready to start again. So you would do closing entries only at the end of the year. So if you're doing financials at the end of the month, you would just go here, and then you would already be starting the other stuff again. But at year end, you have to do your closing entries. Wow, time flies. Okay, so when you do closing entries, it means that we need to zero out our income statement accounts, all the revenue, all the expenses. And we also have to zero out the dividend account if we pay dividends. not on the income statement. Dividends are not an expense. The companies don't get it as a deduction. Okay, so when I say zero them out, if we know that revenue always has a credit balance, then we're going to be making a journal entry to debit our total revenue, so we can make it zero. So all of these things are going to close to retained earnings. So when you look at your statement of retained earnings, and you see what we did here, to get to ending retained earnings, it's the same thing we're going to do with those journal entries. It's kind of like we're acting through the statement of retained earnings. We're pulling the net income or net loss over to retained earnings, and then we're also going to pull over the dividends, okay? So that's how we do those closing entries. The reason behind it, because, logic helps to understand it, is that what good would it do us if we kept adding to that income statement next year? Because then by the end of year 3 or 4 or 5, we wouldn't really know how much income we made that year, would we? We just know this is where we're at after 5 years. And the whole purpose behind the financial statements is to give us information to use. And what would investors say? Well, gee, I don't care about how they've done in 5 years. I want to know how they did this year, because there could be some big loss that's buried in those other numbers, or maybe they had losses in the beginning and now they're doing tremendously better. So that's why we need to start with a fresh income statement each year so that we have a good number we can look at. All right, and now with the balance sheet, we need to keep that going, because at year end, if we have $1 million in cash, that $1 million isn't going anywhere, right? So we just want to pull that balance over to the next year, and that's basically what we do with all the balance sheet counts. That doesn't matter. We can just keep that rolling, because we're going to make sure that it reflects where we are on the day that we label it for our financial statements. So balance sheet rolls over, and income statement and dividends just zero out to retained earnings. So we're always going to have that long-term picture of retained earnings. That's an accumulation account. Okay, and then finally, you do prepare a post-closing trial balance. Making sure that debits equal credits. And the only accounts that you should have left on your post-closing trial balance would be your balance sheet accounts, right? Because everything else will have a zero. Okay. All right, so the next thing I wanted to mention was, and this is just a quick little, maybe it'll help you remember something. Okay. It's just, I don't know if mnemonics help you remember stuff or not, but accounts that you would increase with a debit. So the first one is assets, the dividend account, and the expense account. Okay, so hot day in the summer, you're dying of thirst, okay? All right, how are you going to increase your ability to go on? Have a nice cool glass of lemonade, A-D-E, okay? So I don't know if that'll do it in there. But, and then on the reverse side of it, the accounts that increase with the credit, liabilities, income, and equity. L-I-E, lie. Or if you're from New York, like I was, Long Island Expressway. But anyway,
Yeah.
that's just, I don't know if that'll help you or not, but all right. So So we've been not really talking about any specific type of company, but there are some specific differences in reporting when you come to a merchandising company. Okay, so when I talk about merchandising companies, I'm talking about Target, or Lowe's, Home Depot, Walmart. So they have a little bit of different presentation with their income statement. Okay, because pricing and products are very crucial to a merchandising company, right? So they'll have sales, and they'll subtract what's called cost of goods sold. And that will get gross profit, which is a really important number for them to be aware of, because gross profit helps them determine, are we doing the correct pricing for our sales based on how much does it cost us to get those products in. So this is a very important tool for them to be able to have to see how is their gross profit in terms of their sales, and then usually from there, they subtract their operating expenses. And then that would give them income from continuing operations. Then plus other income, subtract other expense, and net income. So this allows them to see all the costs that are directly related to their product they're selling. So some of those things that go into that cost of goods sold are tied to the fact that when you're a merchandising company, even if you're a wholesaler or a retailer, you're going to maintain inventory. And when you think of a Walmart store, you know they've got a ton of inventory, or Lowe's, or Home Depot, or Target. They're going to have a lot of different items. And they're going to have a lot of different items in terms of, they're going to have nails at Home Depot and Lowe's, and I really can't tell the difference between one nail and another, especially if they're really the same size nail and stuff. So they're going to have a lot of homogeneous type products, and they'll also have some higher end products which are very specific. Okay, so with their inventory, they can keep track of it using the perpetual inventory methods or a periodic inventory method. Most companies will use perpetual, meaning every time they purchase something, every time they sell something, they adjust inventory. Now, even though we're all computerized now and they have point of sale registers that are keeping track of all the sales that are going out, they still are going to actually, at year end, go out and count everything they have in inventory as well, okay? And you've probably seen them. They have these little handheld scanners, and they'll scan all the things on the rows. And then they also have people out in their warehouses that are out there counting it. And usually, they have a team of staff auditors, the new auditors that were just hired from school, out there in the warehouse observing them doing the inventory, or sometimes doing the inventory, like counting. And they have to move, like if they have big towers of boxes and stuff, they have to move all of them, because you could have a big block of boxes. The inside could be empty, so that's why they have to move everything to make sure. But anyway, that's an aside. So they'll either keep perpetual or periodic. Mostly they keep perpetual. Well, the other thing, when it comes to determining the cost of goods sold, how do they identify which product got sold so that they can match it with the right price? So we have several cost flow methods. They may use first in, first out. they may use last in, first out. So the first one would be FIFO. Here we go with the acronyms. The next one is LIFO. Or they may use a weighted average. Now, if they have some extremely high-end type, or say you had a car dealership, this is the best example. When cars come in, they have VIN numbers, usually inside on their dash in a corner. So you can specifically say, okay, this car goes with this cost that we had to pay for it. Whether they bought it used or whether they bought it from the car manufacturer or not. So that's called specific identification. And it's usually for high value, unique items. But first in and last in, first out, and weighted average are used for those homogeneous products like boxes of cereal, nails, anything that's really not distinctly different from the next, other than the brand, okay? So they'll use those cost flow methods to come up with their value for cost of goods sold. Now, the other thing that could go into cost of goods sold is freight. Okay, so with freight, we have two terms. We have FOB shipping point and we have FOB destination. Okay. And if you try to think of these in terms of who owns that product, okay? So if it's FOB shipping point, it means when it leaves the seller's warehouse to be delivered to the buyer, the ownership changes right at the shipping point. So the buyer of those goods is going to pay the freight. For destination, it means that seller is not going to transfer the ownership until they get to the buyer's location. So in this one, the seller pays the freight. Any questions? I know you're probably saying, oh, we've heard enough. Okay, the only other thing that I wanted to mention with regards to that is that, remember with the big thing too is, you really want your cash as soon as you sell something, right? Because cash in hand is a lot more valuable than, someone's obligation that they'll pay you later on. But you really wouldn't be able to do business if you didn't offer credit, right? Because some people, that's just what they're going to do. So what they try to do is offer discounts to encourage people to pay sooner rather than later. So the discounts will be set up like 2/15, say net 30. Okay, and this would be on a credit sale. So if you would ever see the discount, you'd immediately know it was a credit sale. This stands for the percentage. You would get 2% off if you pay in 15 days, the denominator, or you're going to pay the whole amount in 30 days. Okay, so the numerator would be 2% discount, sometimes it's 1%. The bottom denominator is how many days you have to pay to earn that discount. And then if you don't do that, then usually it's 30 days. Sometimes it may be 45, you have to pay the whole amount, okay? And that goes for the retailer if they're buying from a wholesaler, and also from the consumer if they're just buying from a regular retailer. Okay. Let's see the time. Okay, what we're going to do is you can just read through. I think I put something on internal controls. Let's talk about managerial accounting a little bit, just to kind of get some of these words in your head. All right, so flip flip mindset now. Now we're in the laid back inside accounting, all right? No rules, it just has to be value added. But we want to have good information because we want our department and our company to do well. Okay, so a lot about managerial accounting is going to be tied to the costs and the different costs we have. So the first thing is product cost. And usually when you see product cost, they'll bring up period cost. Okay, so with product cost, it's cost directly related to the manufacture of the product. Okay, so it's things like direct materials, direct labor, and overhead. Okay, now the overhead is considered to be indirect costs related to the product. Now, typically something lands up in overhead because it's something that's very hard to specifically allocate. So that's why it usually is an overhead. Direct materials are very easily traced to the product cost, and so is direct labor. Now, the period costs are really support expenses. So it may be the payroll department, it may be the president of the company's salary. They're all the things like that. The utilities for the business office, all these support expenses. The things that you need, but they're not directly related to your product manufacturing costs. Now, we talked about the retailer, they're going to have inventory. Well, if you're a manufacturing company, you're actually going to have 3 different types of inventory. And they're going to be related to the stages of production. Okay, so the first thing usually in manufacturing is you need to get your materials that you're going to use, okay? And so we have, the first one is the raw material inventory. Okay, when they get their orders in and they put their production together, the next inventory, they'll move those raw materials over and they'll go into work in process. Okay, so work in process is going to have your raw materials put in there, your labor, and the overhead will all be applied in work in process. Once you get your product done, then you're going to transfer it over to finished goods inventory. Probably the last thing I want to talk about is, and actually you may hear some of this in with Dr. Evans' lecture, I don't know. We're going to talk about the behavioral cost behavior. Okay, so in order to get our total cost, it's usually split up into the fixed costs and the variable cost. Okay, so when we have a fixed cost, no matter if you make 2 products or 100 products, fixed cost is the same. It's what it takes to just get the machine set up or you're gonna have it no matter how many you make. But as your number of products increase, your fixed cost per unit will decrease. Okay? Because what's going to happen there is you're going to spread that certain amount over more units. So the fixed cost per unit is going to decrease. With variable cost, you know what variable cost is they're going to say it's $3 per product. Okay? So what's going to happen is, with this one, as your number of products increases, your variable cost per unit stays the same, but the total variable cost is going to increase. And in this one, total fixed cost stays the same. Okay, so that's just, you know, I know that was like a pretty important part in managerial accounting textbook. I pulled it out to make sure. Okay, there's a few other things in there. You might want to take a look at that. And I talked about contribution margin, break even, margin of safety. Budgeting is a big part of managerial accounting as well, because budgets are important. And then they use those for performance evaluation, where they'll look and see, here's an expected budget, and here's our actual. And they'll look at the differences, or they call it variances, and they can be favorable or unfavorable. I wrote a little bit on that. And that's called management by exception. You probably cover that in management. But anyway, so does anyone have anything they were trying to remember and couldn't remember and want to ask? Or is your head swimming now, I'm sure? I was going to ask you to just sign this sheet. I didn't know if I was supposed to just keep track of who was in attendance or not. And then I was going to let you take a break